Stockholder equity part 1. First of all, what is equity? Stockholder equity is also called sometimes shareholder equity or owner's equity, and I'm sure all of you would be familiar with this fundamental accounting equation: assets is equal to equity plus liability. So if you make equity the subject of this equation, so equity is equal to assets minus liability. So basically equity is net assets. It's net asset, that is assets less liabilities. This is also called the residual interest. So shareholder equity is shown on the balance sheet. I will show you, and it is the last major section on the balance sheet after liabilities. And this is an important point. The elements of stockholder equity must be clearly classified by their sources. Let me show you. This is it. This is your shareholders equity. You show capital stock, additional paid-in capital, also called the additional contributed capital, retained earnings classified into appropriated or unappropriate. I will explain this as we proceed. And then you show accumulated other comprehensive income we discussed in income statement, and then any treasury stock, company's own stock which company has purchased, and then it shows you the total shareholders equity of the parent, and then non-controlling interest. This is what we will discuss in the coming consolidation. So this is the total equity. Capital stock, sometimes also called the legal capital. So what it is? A legal capital is the minimum amount of money a corporation must keep to protect creditors, bondholders, your suppliers. Remember, your investment in a company in common stock or in preferred stock, it's a cushion. It's a protection for creditors. In case there is a default, your money would be used to pay back the company's debt. So this is an important point to be remembered. And remember, both preferred and common stock, we will discuss shortly, they both have a par or a stated value, and this par or stated value is what you call the legal capital. So what is par? Par basically is the amount, the stated amount for which the preferred or common stock is issued. Preferred stock usually has a par value, $1, $10, $100, but the common stock can have a par value, $1, $10, $100, or it may not have any par. In case if it has no par, then it may be issued for a certain stated value. So there is a difference between par. Par is the legal capital, $1, $10, $100. And when the company issues common stock without par or with no par, it usually has a stated value. Like we sell a share that has a stated value of $10, we sell it for $18. So this extra amount we collect, we'll discuss, is called additional contributed capital. So stated value or the par value, anything received above this amount is called the additional paid-in capital or additional contributed capital. Let's say we have sold a preferred stock with a par value of $10 at $15. This difference between the par or the stated value and this amount at which we are selling, this $5 additionally is called share premium in our part of the world, in South Asia, but in the US accounting literature we call it the additional paid-in capital, sometimes called additional contributed capital, both are the same. Then we have an important concept you need to remember: authorized, issued and outstanding capital. Whenever a company gets registered, it has to disclose in its charter how many shares it can issue. So the maximum number of shares you can issue is called the authorized share capital. This is the maximum number of shares you can issue. Let's say a company, when registered, it disclosed in its charter that it will issue a maximum of 100 shares, right? Out of this 100 share, it has issued 80 shares. And out of those 80 shares, company has purchased its own stock. This own stock, when you buy, this is called treasury stock. If the corporation holds some of its own stock, its own issued shares, they are called treasury stock. So when you calculate the outstanding stock, remember, outstanding stock is equal to issued less treasury stock. So outstanding would be 60. So please, again, this is the maximum number of shares you can issue, called authorized share capital. Out of this, you have issued 80. And out of these 80, you have repurchased your own stock from the market, and these shares are not held by the shareholders. These are called treasury stock. So if you say, what are the outstanding stock? Outstanding stock is the issued share capital less treasury stock. This is the outstanding stock. So as per the regulation, the number of shares for each class authorized, issued and outstanding, they must be disclosed. Okay, so now let us discuss some things about common stock and preferred stock. First, common stock. Remember, common stock, they represent the basic ownership in a corporation. A common shareholder who purchases common stock, he takes on the most risk. He is taking the highest level of risk in a company. Since he's taking the highest level of risk, he also gains the most benefits. This is an important point. Higher the risk, higher the reward. So if you as a shareholder, you are taking a higher level of risk, you are the one who will benefit the most if company succeeds. That's how many people who have invested in common stock, they become billionaires. The issue is that why is it risky? Because when you are a common stock investor, the returns are not guaranteed. You may not get any dividends for many years, right? So shareholders are not guaranteed dividends or assets if the company dissolves. If the company is liquidated, you may not get anything. But the good thing is that being as a common shareholder, you control the management. You have the right to vote on important matters, right? And when the company earns profit, you are the one who receives the sizable chunk of profit, either in the form of dividend or these earnings become part of your retained earning, which belongs to you as a shareholder. Remember, this is important. You are the owner. You are the one who decide who would sit on the board of directors. And you are taking a hell lot of risk. If the business fails, you fail. If the business fails, you may stand to lose everything invested in the company. Because the process is that if the business is liquidated, if it's closed, the business will sell all the assets, will pay creditors, will pay bondholders, will pay bankers, will pay preferred shareholders. If anything is left, then you will get that leftover. So that is what causes risk. There is an important point also about common stocks called preemptive rights. Preemptive rights mean, let me explain the helping example. There are three shareholders, A, B, and C. Let's say they hold 100 shares, 200 shares, and 200 shares respectively. That means they are 20%, 40%, 40% shareholders. If new shares are issued, let's say company issues 10 new shares. These 10 new shares will be offered to these shareholders in proportion of their existing holding. So these 10 shares, out of this 10, 20%, 2 shares are offered to A, 4 to B, and 4 to C. If they exercise their right to purchase, fine. If they decide not to, then company can sell these shares to general public. So preemptive rights mean the existing shareholders will have the first right to any share issuing in proportion to their current shareholding. The idea behind is that we want to keep the interest of existing shareholders unaffected despite issuing new shares. Next, we have the preferred stock. Remember, preferred stock is preferred over common stock because if company earns profit, the dividends are first given to preferred stockholders, then to common stockholders. If the company is liquidated and the liquidation proceeds are being distributed, first they are given to preferred stockholders, and if anything is left after preferred stock shareholders get their share of liquidation proceeds, only then common stockholders will get. So this is an important point to remember. Preferred stockholders are the stocks with special preferences and the features that are different from the common stock. Preferred stockholders may get preference in dividends. I told you they also get preference in liquidation. But the preferred stockholders, they are not the owners of the business. They usually have no voting rights. There are different types of preferred stock. Let us discuss these one by one. One is the cumulative preferred stock. Cumulative preferred stock means it accumulates unpaid dividends. And these dividends must be paid in the future before common shareholders gets any dividend. Let's say we have a bad year in 2020, a bad year in 2021 and 2022, but in 2023, we had sizable profits. So if the preferred stockholder, this preferred stock is cumulative, if no dividend was paid in these 3 years, they will become in arrears and they will be paid all of them in 2023, right? So if preferred stock is not paid in these 3 years, it has to be paid in 2023 before any common stockholders get their share of dividends. So these unpaid dividends in these 3 years, these unpaid dividends are called the dividends in arrears. And dividend in arrears is not a liability on the balance sheet, but it needs to be disclosed on the books. It's not a legal liability. So this is an important point to be remembered. Then we have the next classification, non-cumulative preferred stock. Clearly, non-cumulative preferred stock does not accumulate unpaid dividends like this one. So if dividends are not declared in any year, finish, no dividends. Preference shareholders lose the right to those dividends for that year. Then we have participating. This is important. Participating preferred stock, as the name suggests, it allows preferred shareholders to share an extra in dividends. So this participation can be full or partial. If they are fully participative, that means preferred shareholders share equally with common shareholders in extra dividends after they get their fixed amount of dividend. Remember, participating preferred stock holders, they not only receive their fixed dividend, but they will also share profits equally with common shareholders if they are fully participating. And if they are partially participating, what does it mean? It means that the preferred shareholders share in extra dividends, but only up to a certain limit. So let's take an example. If a shareholder, a common shareholder gets $5, right? A common shareholder gets $5, whereas as a preferred shareholder, he gets only $2. So if the preferred stocks are fully participating, then these preferred stockholders will be given an extra 3 to bring it at par with the common shareholders. This is in the case of fully participating. This $2 is the fixed dividend you get as a preferred stockholder. You will get an extra $3 to bring your dividends in at par with the common shareholders. If it's partially, then out of this extra 3, maybe you will get 1 or 1.5 or maybe 2, but not full as in the above case. Then we have non-participating. As the name suggests, non-participating preferred stock only gets dividends as per their preferred percentage. They do not get any extra dividend. Then we have preferred on liquidation. Well, it means preferred stock can have a preference for assets if the company is liquidated. Let's say we have a certain plant P3, for example. So if these preferred stocks are preferred upon liquidation, that means the shareholders, the preferred shareholders, they have preference for this particular asset. If the business is liquidated, the preferred shareholders will get proceeds by the sale of this particular asset, right? But if this value of asset is way higher than the par value, if this preference is much higher than the par value, it must be disclosed, and this information should be in the equity section of the balance sheet, and of course not in the notes to accounts. Then we have convertible preferred stock. As the name suggests, convertible preferred stock can be exchanged for common stock. This normally happens at a specified conversion rate, like for example, if you hold 1 preferred stock, it is convertible to 3 common stocks at a certain point in time. So if you have preferred stock, then you can convert that preferred stock into 3 common stock at this conversion price that has been agreed at the time of issue. Then we have callable or redeemable preferred stock. As the name suggests, that these preferred stock have a definite life. Callable means these preferred stock can be repurchased by the company at a set price. So normally this is done at the company's choice. That's why it's called callable, and they are beneficial for the company. So the repurchase price at which the company will purchase these shares back must be disclosed on the balance sheet or in the footnotes. Now this is interesting. Mandatorily redeemable preferred stock. As the name suggests, that these are like debt. That's why they are considered a liability. So any mandatory redeemable preferred stock, 5 years, 10 years, it has to be fully redeemed at that date, at that time. So the company must buy back the stock on the maturity date after 5 years or 10 years. It's important. So this type of stock clearly is like a debt. So that's why it is classified as a liability. It is reported as a liability. On January 1st, year 1, Samuel Company issued 100,000 shares of 5 par common stock and 25,000 shares of 10 par fully participating, this is key, 8% cumulative preferred stock. No dividends were paid in year 1. Cash dividends 101 were declared and paid in year 2. Now this is important. Remember, since the shares, the preferred stocks are cumulative, calculate what you need to pay every year. Determine the dividends to be paid on the preference or preferred and common stock. Okay. See, first of all, this is the total amount of dividend declared and paid in year 2. Remember, we have 25,000 shares preferred stock with $10 par on which we pay dividend at the rate of 8%. So that means first we need to calculate the dividend in arrears. 25,000 times 10 times 8%. That was for the prior year. Dividends that is for year 2, 20,000. So 101 2020, that means we have got 61,000 balance. Remember, this is the important point. We need to pay common stockholders the dividends. And what do we do? Common shareholders must receive an equal dividend as the preferred shareholders. Same percentage. So 100,000 shares outstanding at 5 par 8%, that is 40. Right? So what remaining balance we have out of this now? 61 less 40. This is for the common stockholder dividend. This 21,000 will be shared between the preferred stockholders and common stockholders in proportion to the par value of their individual holdings. Preferred stock par is 25,000 shares times 10, that is 250. And common share 100,000 times 5, 500. So we use this par proportion and distribute 21 accordingly. So it's going to be 250, 500, 750. So 250 upon 750,000 times 21 and 500 upon 750,000 times 21. So if you split this amount, it will be 7,000 for preferred stockholders and 21,000 for common shareholders. This is it. And then if you calculate the total amount paid to preferred stockholders, these are the two, current year and prior year, plus 7,000, 47, and then for common stockholders, 14 proportional share and 40,000 we discussed previously. So that's the total amount of cash dividends distributed. So sometimes we have to calculate book value per common share. The denominator is very straightforward. Common shares outstanding at a particular point in time. But what is the common shareholder equity at a particular point in time? For this, we take the total shareholder equity including preferred stock holders. So we need to calculate the common shareholder equity. So from this, we take the total shareholder equity, and from this we deduct the preferred stock outstanding at greater of call price or par value. Let's say if par value is $500,000 and the call price at which company can recall the preferred stock to be redeemed, if it is let's say 525,000, then we take 525. We need to take the greater. Conversely speaking, if your call price is 490, then we take 500, greater of call price or par value. And if there is any cumulative preferred dividend in arrears, that needs to be deducted. So once we make the adjustment, then we come up with the common shareholder equity, and this is what is put as a numerator to this formula. Next, additional paid-in capital. Additional paid-in capital, we know, is the money contributed above the par or the stated value of a stock. For example, a company issued a share that has a par of 10 or a stated value of 10 at $15. This extra $5 is what you call the additional paid-in capital, or sometimes called the additional contributed capital. Is it the only way? No, it can come from many different transactions. For example, it can come from sale of a treasury stock at a gain. Let's say we sell a treasury stock which we bought at $18, and now we are selling it back to new shareholders at $28, for example. So this is our purchase price of this treasury stock. This is the sale price. This extra $10 is not income. It doesn't enter income statement. Please note, this is crucial. This is not income. This is credited to additional paid-in capital. So any gain on sale of treasury stock goes to additional contributed capital or additional paid-in capital. Next, liquidating dividends. What are they? Liquidating dividends is also known as the return of capital. It represents a return to shareholders. It is paid out of retained earnings. So, or sometimes it is paid out of additional paid-in capital. So the entry that we make is we debit retained earning or the additional paid-in capital, and we credit dividend payable, let's say $10,000. And when it is actually settled, we debit dividend payable, credit cash or bank $10,000, right? When bonds are converted into stock, any amount over the stated value or the par value of the stock is additional paid in capital. Let's say, take an example, we have converted some bonds with the, let's say, book value, keep it simple, $100,000. So we are going to debit bonds payable with $100,000, and that has resulted in a common stock with a par of 80,000 being given to shareholders or to these bondholders. So this differential 20,000 that goes to additional paid in capital, right? Then we have small stock dividends. Yes, small stock dividend means if the company issues small stock dividend, which is normally less than 20 or 25% of existing common stock, then the value of the stocks that is given to the shareholder is recorded in the books of account at market price. Let's say on the date of declaration, we issued a small stock dividend, let's say 10% of existing shares outstanding, and let's say the number of shares is 1,000. The par is $10, but the market price at the date of declaration was $25. What you do? You debit your retained earning 1,000 times 25, not par. 1,000 times 25, you debit your retained earning, $25,000. You credit your common stock with par, 10 times 1,000, that is 10,000. The 15,000 extra goes to additional paid in capital. So this way, your additional paid in capital account gets affected. What about the large stock dividend? Let's say if the stock dividend is more than 20 or 25% of common stock, let's say we have issued 3,000, let's say. We have issued 3,000 common stock as stock dividends. What we do in that case? In that case, ladies and gentlemen, we simply debit retained earning with par, 3,000 times 10, 30,000 retained earning debit and common stock credit. No impact on additional paid in capital. In case of large stock dividend, you simply take the par. Next, we have retained earnings. This is how we determine our retained earning. Net income for the period, deduct any cash dividends or property dividends or stock dividends declared, add or less any prior period adjustments, add or less any accounting changes that are reported retrospectively. We will discuss these as we proceed. And this gives you the retained earning for the period. To this, we add the retained earning balance brought forward. And then what the total gets, that is the retained earning balance to be carried forward, the new balance of retained earnings. So this is what retained earnings are. Retained earnings are basically your accumulated profits and losses for the period. So these are the earnings that have not been paid out as dividends. See, these are the earnings from which dividends have been deducted. So these are undistributed earnings, you may say, right? So they reduce when you pay dividends. They reduce when you make some prior period adjustments, some accounting changes that are to be reported retrospectively. They also may increase or decrease when we make certain transactions with the shareholders. Regarding, we just explained the idea of small stock dividend. Your retained earning is debited. So retained earning, they do not include treasury stock or other comprehensive income. As you can see, these are the elements added and deducted from your net income to give you retained earning. And if there is a negative balance in retained earning, it is called a deficit. Next point you need to remember is that retained earning can be classified, means retained earning can be appropriated. So basically there are two types of retained earning, that is unappropriated and appropriated. What's the difference between these two? The unappropriated retained earning is available to shareholders and can be given as a dividend. But appropriated retained earning means that these amounts have been set aside from earnings and they cannot be used for dividends. For example, we may have set aside certain amount of money from retained earning to meet legal restrictions, or maybe some bond indenture requirement, or maybe for some contingency. So when we transfer certain part of our retained earning to appropriated, the entry we make, we debit the retained earning unappropriated and we credit the retained earning appropriated. This means this amount, let's say $100,000, has been set aside to meet any contingency, or maybe it's been put as a legal restriction, like in the case of bond indenture, or just to put this money aside for some purpose. Let me explain what could be the reason we have put these amounts aside. We may have appropriated earnings for general contingencies, or maybe for possible future inventory declines, or maybe for future plant expansion. Then we have accumulated other comprehensive income. We have discussed this quite in detail in our previous lectures. Accumulated other comprehensive income includes some pension adjustments, some unrealized gains and losses on available for sale debt securities, some gain and loss on effective portion of cash flow hedge we discussed, and then some gain and losses on foreign currency translation adjustment. We discussed this in sufficient detail. So they combine with the net income to give you the comprehensive income that we already discussed. So your comprehensive income has two components: net income, that is the income statement, plus other comprehensive income. So this other comprehensive income that keeps on piling up and shows up on equity section of your statement of change in equity, and we report it as accumulated other comprehensive income, right? This accumulated or total accumulated other comprehensive income is shown separately in the equity section. That means it's separate from capital stock or additional paid-in capital or retained earnings. It needs to be reported separately. Treasury stock. Treasury stock is a corporation's own stock that has been issued and then repurchased. You have your own stock which you previously issued, and now you have bought back, you have repurchased, and it is still with the company because it has not yet been retired. So such stocks are called treasury stock. And there are two ways we can report treasury stock. There are two methods. One is the cost method, other is the par or stated value method. We'll discuss in detail. The question that you should ask is that why a company should purchase its own stock? There are many reasons. Maybe the firm has purchased its own stock to reduce the market holding, outstanding shares, just to avoid any threat of takeover. Or maybe company has purchased these stocks to give these shares as stock dividends to shareholders, or maybe the company would like to give these shares as a stock compensation to employees. There could be many reasons why the company has purchased its own stock. But the important point to note is that treasury stocks, they do not have any voting rights, they don't receive any dividends, and these stocks which we buy, they are not considered outstanding. They, in fact, let's say if the total number of shares the company have issued is 1,000 and 200 have been repurchased as treasury stock, outstanding shares are 800, and they are the one entitled for voting, entitled to receive dividends. Let's say these 200 treasury stock which we purchased at a cost of $3,000. Now this $3,000, which is the cost of treasury stock, a portion of retained earning equal to 3,000 is set aside, or it is restricted, and it cannot be used for dividends. And it is not a legal compulsion, it's at the choice of the company. So we have two methods to account for treasury stock. One is the cost method, other is the par value or stated value method, or sometimes called the legal method. Let's discuss. This cost method is the one that is used more extensively. About 95% of the issuers, they use cost method. Now let us discuss how this is done. Let's say we have issued 10,000 shares with a par of 10 each share, sold for 15 per share. Clearly, this additional $5 is the additional paid-in capital. So the entry will make 10,000 times 15, 150,000 debit cash. The common stock has a par of 10. 10,000 times 10, 100,000. That is the common stock credited, and the difference between these two is the additional paid-in capital. Okay, now that was the original entry. Buyback above issue price. This is your issue price. 200 shares were repurchased for 20 per share. This price is clearly higher than the issue price. What we do in this case? Let's see. 200 shares repurchased at 20 each, so that means 4,000 cash is being spent. So your debit treasury stock at cost 4,000 and credit cash. Now out of these 200 shares we bought at 20 each, we are reissuing them above the cost. Our cost was 20 and we are now reselling them for 22. What we do in this case? So we receive 100 times 22, $2,200 cash is received. It's fairly straightforward. What is the cost of these shares? We bought them at 20, so 20 times 100. 2,000 is credited to treasury stock, and the differential 200, that goes to additional paid-in capital. So this is the case when you reissue the treasury stock above the cost. What if you reissue above at below the cost price? Reissue below cost. 100 shares repurchased for 20 were sold for 13. Remember, we purchased at 20, now we are reselling them at 13. That is clearly below the cost. Now we will debit cash, 100 times 13, $1,300 cash credited. See, there is a problem now because we issued originally at 15 and we are selling them not only below our cost but even below at the original issue price of $15. So what we do? So this $7 loss would need to be split. 5 goes to retained earning and $2 goes to additional paid in capital. So 100 times 2 and 100 times 5. So we debit additional paid in capital 200, we debit retained earning 500 and we remove the stock by crediting the treasury stock at cost. Please note, whether you issue at the price higher than the issue price or lower than the issue price, it is not income in any case, never. It only goes to the your retained earnings or additional paid in capital. It never enters income statement. This is a very important point to be remembered. This is now the par value method, which is only prevalent 5% of the time. Very few issuers use this method. Original issue is that we sell 10,000 shares of 10 par value common stock at 15 per share. Clearly, the entry is the same as we saw previously. We debit cash, credit common stock with par and credit the additional paid in capital with the differential. Let me show you. Debit cash 15 times 10,000. Credit common stock 10 times 10,000 and the differential between 15 and 10, $5 per share, 50,000 enters additional paid in capital. So this is the original issue. Buyback above issue price. 200 shares were repurchased for 20 per share. This is the original issue price. We are buying at a higher price than the issue price. The entry we make, par method, remember. So you are buying back 200 shares. So you're going to debit 200 times 10, 2,000. Treasury stock, what is the additional paid in capital involved? $5 per share. Remember, 10 versus 15, $5. So you're going to take $5, which was the additional paid in capital at original issue. 5 times 200, 1,000. That is the reversal of additional paid in capital. And the balance of $5, because remember, we are repurchasing at 20. So that is $10 higher than par, of which $5 is the additional contributed capital on the initial issue, and $5 we are paying more. That goes to retained earning. Remember, any treasury stock transaction does not enter income statement. They all go to additional paid in capital, retained earning, never in income statement. So debit treasury stock, debit retained earning, and debit additional paid in capital, and credit what you have paid. 200 shares at 20 each. Now here's an important point to note that if there is no additional paid in capital balance in the treasury stock account, remember treasury stock account has its separate additional paid in capital. If there is nothing available, then the whole of 2,000 is debited to retained earnings. It's an important point to be remembered. Buyback below issue price. Remember, we issued at 15. 200 shares repurchased for 12 per share. That is $3 less than the original issue price. Okay, so see, we have 200 times 12, $2,400 paid. That is cash credit. Okay, what's the difference between the original issue price and the price of repurchase? 12, the differential 3. It goes to additional paid in capital treasury stock account, and the balance is debited to the additional paid in capital account. That is 200 shares at 5, 1,000. Now we are reissuing 100 shares repurchased for 20 were resold for 22, higher than the price we paid. Now this one is fairly straightforward. 100 shares at 22, you receive 2,200 cash. Common stock has a par of 10 each, 10 times 100, that is 1,000, and the additional 12 times 10, 100, that is 1,200 goes to additional paid in capital. 100 shares repurchased for 20 are now being resold at 13 each. Again, it's fairly straightforward. 100 times 13, that's what you receive. And how many shares are you issuing? 100 with par of 10, 1,000 credit to common stock, and the differential goes to additional paid in capital. This is it. These are the two methods shown side by side, the cost method and the par value method. In the cost method, you have a single amount of treasury stock reported at cost as an unallocated reduction in equity, but in par value, you split this amount into its components. Now this 4,000 is split between 2,000 deducted from common stock par value, 1,000 from additional paid-in capital, and 1,000 from retained earnings. So it's just that the amount is the same, but it is being netted off. So this is the par value method. This is the cost method. Please see the entries, do some computations, and it will make much more sense. So what if we do not reissue, rather we retire? Retirement of treasury stock, price is more than the stated or par, and price is less than stated or par. Let's see these both scenarios in an example. Now let's say if all the 200 treasury shares reacquired for 20 were retired rather than reissued, the following entries would be made. Let's see one by one. Retirement of shares, cost method, 200 shares of 10 par common stock originally sold for 15 are reacquired for 20 and are retired. Remove common stock from books, debit common stock at par, right? Credit your treasury stock at the amount that you originally recorded. The original $5 additional paid-in capital is removed by debiting it, and the differential is put in retained earnings, and the stock is removed. Retirement of shares, par value method, you simply remove the par of stock, common stock debit, and par removed from treasury stock. So common stock debit at par and treasury stock credit at par, and accounts are balanced and your stocks are removed. Next we have donated stock. What is donated stock? Donated stock is a company's own stock received as a donation from shareholders. So basically there is no change in total shareholders' equity due to donation. So what we do, the number of shares outstanding clearly would decrease, and it would increase the book value per share. Let me show you how it works. Remember, the donated stock is recorded at the fair market value. Let me show you how it is incorporated in the books. So your donated treasury stock, it is debited, and additional paid-in capital credited. So these two are equity amounts. So basically equity in total stays the same. Equity stays the same, but number of shares outstanding decrease, and this is what raises your book value per share. Remember, book value per share is equal to common shareholders' equity divided by number of shares outstanding. Since the common shareholder equity stays the same, number of outstanding shares decrease, and this would raise the book value per share amount. But if the donated stock is sold, the journal entry that you would pass is you debit cash, whatever the sale price you receive. You credit your donated treasury stock. Now the important point here to note is, if your selling price is higher than the original fair market value, additional paid-in capital will be credited. It's fairly straightforward, no big deal. Put some numbers and it will make perfect sense. And if your selling price is less than the original fair market value, then you debit additional paid-in capital.